Welcome to Your Money Matters Show. Yes, again, this week on Tuesday at 5 p.m, we are talking about, yes, your favorite subject on this planet and least favorite, and that is, of course, money. So, yes, I'm not sure if you've missed me. I've been away for a couple of weeks. I was away, I'm afraid, in Italy, bathing, sunbathing, and eating tons of pasta, and of course lots of other things that I won't mention. But of course, going back to the subject, it is your money, and the question is, what are you going to get today for your money? Yes, today we are going to be talking about one of the most biggest subjects, I suppose, in the country, and the topic is about mortgage. Yes, mortgage. And we have, of course, a guest for you, Robert, who is an independent financial advisor. Hi, Robert.
Hello. Hi, Ripon. It's nice to be here. Hello.
Thank you, Robert. So before we get back to you, of course, first thing, of course, we need to start with is our tips of the week, because that's the ceremony that we seem to follow. So today's tips of the week is... Yes, today's tips of the week is for you to save your money on mobile phones. So the question is how? So here are my tips on ways to save. First is choose the right type of deal. With a standard phone deal, you sign a contract, typically for 2 years, and choose the handset you want. You pay little or nothing upfront, but there is a fixed monthly charge that gives you a set amount of call time, text and internet data, and also covers the cost of the handset cover the term of the contract. For many people, these deals are poor value. First, if you're a light mobile phone user, spending less than £10 a month, say you'd probably be better off with a pay-as-you-go contract where you are only charged according to your use. You can get a pay-as-you-go deal on your existing mobile or buy a new phone handset. Of course, that's number one. But the second one is choose the best network. Next, see what different networks have to offer. This is a competitive marketplace in which big four providers, when I say big four, I mean 3 Mobile, Vodafone, EE, and O2. They pretty much dominate the mobile phone market, are facing challenges from smaller competitors. So it's worth you looking out for the best network in the market. Third, avoid contract pitfalls. What does that mean? If you do opt for a standard monthly contract, there are several traps to avoid. First, when the contract comes to an end, find the cheapest replacement deal. Otherwise, some providers will continue charging you the same monthly amount. Fourth, prepare to haggle. If you're happy to continue with your current provider at the end of your contract, either with a new phone deal or on a SIM card only alternative, push for the best possible deal. Previous, of course, which I'm talking about, an online magazine called Which, did a research and found that average hagglers save more than £70 on the annual phone cost if you haggle. So that's my tips of the week. And that is, choose the right type of deal. Second, choose the best network. Third, avoid contract pitfalls. Fourth, prepare to haggle. So, yes, we are back on our major subject. And the subject is no doubt is on a big topic. So, Robert, you are the man who is going to be answering my questions. Okay. So before we do that, briefly tell us about your background.
Okay, well, I'm actually an independent financial advisor. So my job is to give financial advice to people across the country. I began years ago, interestingly, at the medical school, not at the financial advisor school. And later, having decided that what I was doing there, medical research, wasn't for me, I moved over into, first of all, international banking, and then to be a financial advisor. And I've been a financial advisor, either running my own business or providing financial advice for people independently for a great many years now, over 25 years, in fact. So I've been doing quite a bit, and currently I'm part of the financial advisors professional body in London as well. So we do a number of other things.
So I can assume that you're an expert when it comes to financial advice.
Don't know about that. Nobody's ever an expert, but we'll do our best to see what we can find.
Okay, so let's start with the basics, because obviously, in my opinion, the world of finance can be very complicated.
Yeah.
So what is the role of mortgage in the context of banking?
Well, in the reason for mortgages and the reason that mortgages exist goes back to the middle of the 17th century in England, where groups of people got together who were generally working people, and they actually put together schemes where they put money in, and their idea was that they would actually pay sickness benefits to people if they were ill, and pay perhaps some death benefits to people if they died while working. And over time they realised, well, also, because they had the fund of money, that they could actually lend this money to people to help start buying homes. And what happened was they used some of the money to buy homes, they paid interest to the people putting the money in, and at the same time they then charged interest to the people who were actually buying the homes. So they became the foundation of the building societies. And there's a strong tradition in England, which is very different than Europe and other countries, where you don't rent, you're expected to build up and buy over
Absolutely.
time. Yeah, and this is one of the fundamental differences in between the UK and most of Europe, for instance, France, Germany, where there's a protected rental system and people are expected to rent and it's unusual to buy. Here there's a strong expectation that young couples starting will build up and individuals starting will build up to actually have their own homes instead. And what's really in it for the lender is the lender has money, he has lots of money, and he wants to get a good return on it. So he gets a return either by charging interest or in other circumstances charging a fixed capital markup if he doesn't feel it's appropriate to charge interest. And therefore he makes a profit on that money in a very, very safe way generally, because people always try and pay for their houses.
Absolutely.
So he has a very safe investment, which makes him a very good return. And that's what's in it for them, really.
So obviously, lending and borrowing, it's kind of ingrained in our society. So the question would be is, when someone is making an application or contemplating in getting a mortgage, what is it that we ought to look out for? Well,
one of the main things now, as so much lending is done by computer rather than the old way, which the old way was one went into a bank, and a bank really made a judgment about you and whether you thought you'd be reliable, and he was less worried about what you were earning. Nowadays, it's a rather different system because the lending is done by computers, making sure everything is okay. So, first place to start really is to make sure your credit history is in good order. So, it's possible to have a mortgage when you've had credit problems. That's not necessarily a worry. But where possible, if you can keep your bills up to date and make sure that your credit cards are paid if you have credit cards, and make sure any debts that you have are paid properly, then that will help a great deal. Now, the other element of it is that quite often a lender, if they want to give you any money, and it's your first time, for instance, as a buyer, a lender will actually say, well, can you show us 6 months worth of bank statements and also some utility bills to prove who you are, and they'll also want to see 6 months worth of salary statements or consistent earnings. So the two big things the lender will look for, one is that your bank statements are in good shape, and the second is that they'll look to see that your earnings are consistent enough that you can actually afford the mortgage. So those are the main things, I think.
So where does a reasonable lender fall into this?
In the sense that a reasonable lender would look at the ways, where possible, the lenders will want to lend the money.
Okay.
Because that's how they make their living. So they're keen to actually lend the money. Sometimes it can be harder than others because of the economy and things of that sort. So in bad economic times, sometimes it's difficult for them to lend because it's hard for them to get the money. But there are many, for instance, traditional building societies still have the old system of people paying money in who are depositors, and they can lend a certain proportion of their deposits. And by law, they're limited to how much they can lend. But where possible, they're keen to lend it. So the middle of the road building society will look, again, will be very strict nowadays because of modern law. They'll be very strict at looking at your bank statements. They'll be very strict at making sure that you've got proper identity evidence for them. So having passports, driving licenses, a recent gas bill or electric bill is very valuable. A mobile phone bill doesn't work for this.
Why not?
Because it doesn't tie to your address in the same way that a gas bill or an electric bill must do. So, for instance, a gas bill will have your name on it and also the address that you're living at, where you're paying for the gas. So the lender knows that's pretty good evidence of your address. And normally a passport or a driving licence that's up to date is very, very good for that. So having those up to date is important. But the middle of the road lender will be keen to lend. They will love it if you've got a good regular salary. If you have overtime, they like that too. If the overtime comes in, some weeks it's good, some weeks it's bad. They'll average about half of it over say 6 months or a year, and count that as well towards your salary. And then, of course, if you're self-employed, they want to look at accounts. So if you're self-employed, having perhaps as much as 3 years accounts is important. Sometimes you can have fewer, but it makes the choice of lenders less and less then. So a mainline lender will then be keen to lend if you have good credit, you have a good salary, and you've kept everything in order. A lender will be keen to lend to help you buy your property. And typically they'll lend between, let's say, between 75% and 95% of the value of the property.
Well, we've covered kind of briefly around having your finances in order, but in terms of your finances being in order, where does credit reference agency fit in?
They're very important because so much now of mortgage lending has to be double-checked by computer. So they're making sure that the person lending isn't making a mistake. Then the computers will check your credit using a credit reference agency. Now, there are a number of them.
Absolutely.
We can name several. Experian is one of the most famous.
Equifax,
Core
Credit.
Or Core Credit, and all of the above. Yes, they're all well-known and respectable agencies, and they will have a certain amount of information on your credit, which is provided quite legitimately by, say, the gas people or your credit card firm or your bank, to show that your accounts are up to date. And if you have a good, they do something called credit scoring, where they actually look at your credit. They also look at your personal circumstances. So, for instance, what they're really trying to do in the background is something we call affordability, which means that they're trying to make sure you can afford the mortgage and keep on paying it. So what they'll look at is first of all, the ability of you to actually pay the loan, but also to make sure you've got enough money to pay your bills. So they do that and feed your family. So they do that by doing something called credit scoring. Now, that's a little bit of a dark science because different firms do it differently.
Right.
And they never tell you how they do it. They'll never tell you.
That's the annoying thing, isn't it? So how can you be consistent?
Well, this is the thing, that consistency doesn't exist between lenders and everything else. There are overall, with mortgages, there are overall and overarching rules that they have to try and stick to, which is why so much is done by computer now.
What are the rules?
The rules are basically that they mustn't lend too much to somebody who might then go under strain and then not be able to pay it. And part of that is because that makes it difficult for them because they've lent the money and they can't get it back. But the other side of it is, as we both know, debt is very, very stressful and very demanding for people. So if they put people into a position that they then are really struggling to pay the mortgage and they're worried and they're upset, they don't want to be in that position either. So most lenders are very helpful and they try and help, but they'll try and only lend enough to make sure. So one of their rules is to make sure don't lend too much, but they'll certainly lend enough where they can if you can afford it and if the property is good.
So there is a balancing act, it seems.
There is, yes, very much so.
So, I mean, in terms of looking at, of course, affordability test and looking at the intentions of the banks and, of course, the debtors, where does the regulator come into this?
Well, the regulator has become more involved in recent years now. One of the changes is that mortgages originally were actually not regulated by the Financial Conduct Authority for a long time. But in recent years, the Financial Conduct Authority has now become much more involved, and it does require regulation. I was one of the first people to take exams in mortgages because they began to come along, and we now do mortgages, lifetime mortgages, which are special mortgages for the elderly and things of that sort. And all of those require us to stay up to date and also require us to pass exams. So this is one of the areas that the regulators come into now, that he would expect somebody advising you on a mortgage. And many people are advised on mortgages, whether they go just into the bank, they still see an advisor of some sort, or they take independent advice from somebody such as myself. That the role that the lender actually then plays is that, or the regulator then plays, is that they make sure that where possible the lender is behaving in a correct and proper way. And for instance, things like bank statements are properly checked and that everything adds up. And they'll really just make sure that the job is done as well and as fairly as possible to people.
Well, we've talked about different players. We talked about the ethics of mortgage. We've also talked about the role of credit reference agencies and, no doubt, the regulator. But what we haven't yet talked about is mortgage itself.
No.
So the question would be what types of mortgages are there in the economy?
Well, there are several, and the most common within England is the idea of you can have a mortgage where you lend a sum of money on part of the value of your house. So if I'm very, very careful in explaining that, the lender will actually lend you, probably very rarely won't lend you all of the value of the property that you're buying. They'll lend you part of the value of the property.
What do you mean by that?
Well, they'll lend, for instance, if they want to have you to have a mortgage, they would love to lend one at, let's say, 3/4 of the value of the property. And then you would have to put in money to buy the rest of the property, or perhaps your family would, or on some occasions there are special government schemes where government agencies help as well, to where you put in at least a certain amount of your own money, but some of that gap is made up. Now, lenders won't just lend at 75% of the value of the property. Some will lend at 85, some even at 95. But of course, the more they lend, especially if property values then fell, the more careful they are that you can carry on paying it back. So that's really the role that the lender would have in that.
But going into diversity in terms of mortgages, go ahead.
Yes. So now, just tell me exactly what you mean by that, Ripon.
So there's lifetime mortgage, there is other types of mortgages.
Oh, there are lots, yes.
Well, tell me the most prominent ones that you and I mostly come across.
Okay, the ones that we would most commonly come across is what's called a repayment mortgage in England. And what happens there is that you get a certain amount of money to buy your property from the lender. You then begin to pay the lender back, and you pay him back a mixture of both the interest he charges and some capital. And over time, let's say over 25 or 30 years, you actually pay off the value of your property. Doesn't stop you moving, but you can actually move to other properties, then have another mortgage, or even keep the same one. And you can, over time, gradually pay that off. For some people, there are different sorts of mortgages. So you can have a mortgage where you just pay the interest. And that's on the basis that you would find another way of paying the mortgage off. Perhaps you might have some money invested, which you feel will grow, for instance, in ISAs and other things, where you feel that your mortgage that the ISA would grow enough that you could pay your mortgage off later. You might even be expecting it from a business that you could sell, or you might even have the money in the bank, but prefer to just pay the interest on the loan because you might sell the house perhaps or something later on.
So what is the risk of just getting interest-only mortgage?
Well, the biggest risk of just having an interest-only mortgage is getting to the end of the mortgage and discovering that you can't pay it off because you haven't got that money that you were talking about. So lenders will always be more careful about lending to you because it's high risk. But on the other hand, it's still very good business because they're getting the interest. And if you can be sure that you can pay it off in the way that you promised them, then this is often a very good way of doing it. It's less popular now because people feel it's much safer that you pay the mortgage off slowly over time. And in other words, you pay capital and interest. And obviously, in some cases, for instance, there are also Islamic mortgages which are consistent with the Hijira, where you would pay capital, but also a fixed markup on the property that's bought for you. And that's not really paying interest because it doesn't change when interest rates change. But what happens is that you're actually, one of the banks will buy the property for you outright, and you make steady payments to chip away at that loan until it's fully paid, and you pay them the capital back, but also a fixed markup for having bought it for you at an early stage. And the only place that really legislates against somebody of the Islamic faith when they're doing that is that you'll pay stamp duty twice.
Why is that?
Well, because when you buy a property, you have to pay a special tax called stamp duty, and in most cases that applies. For some people who are first-time buyers, they may be able to avoid it, but not everyone can. So what would actually happen is that over time, stamp duty, well, first of all, stamp duty needs to be paid when you buy the property. So when the bank buys the property for an Islamic mortgage, stamp duty is paid, and that means you have to pay it because they won't.
Right.
When you actually then buy the property back and you make your last payment for an Islamic mortgage, and you actually own the property, you have to pay stamp duty again because you've bought it back now.
Okay, so it looks like there's a lot for us to go through still, Robert. So obviously, but I've got a couple of tweets. Before I go into talk about tweets, but there's a couple of case studies.
Yes.
So let's make it real. Obviously, listeners, you are listening, but you need to know what's going. How does that fit in with your life? So I've got Penny. Penny, who is 45, she just separated from her husband. She has one child, 16-year-old. There is a mortgage on the property, and 5 more years to go. But it's not actually quite clear if it's repayment or interest only.
No.
She's worried she might default. What advice do you give her?
Well, in the first instance, and this is unfortunately a very common thing that we have, there are 2 routes that Penny has to look at. First of all is to see, really, is she actually able to do a job herself, and is she doing a job? If she's doing a job, can she manage to pay the mortgage and do everything else and feed her family and other things? Now, from what she's saying there, she's worried about that. So there are 2 options. Now, one, unfortunately, is that if there's been a separation of some sort, she may need to look to her husband to help pay, because he may still have a responsibility and liability for his family.
Because of the kid.
Because of the little boy, yes.
And also she must have lost income, knowing that she has to look after the kid as well.
Oh yes, there are so many things. If she's stayed at home and looked after the house for him while he's been able to work, then effectively that's like her putting money into the house.
Right.
Because she's put her own time and
Absolutely.
effort and love into the house. So that means that often in England a court will say, particularly if a child's involved,
Absolutely.
will allow some payments between an ex-husband or ex-partner and to Penny, for instance, so that she can actually help make ends meet in that way.
Okay, so let's now talk to Layla. Our Layla, she is a career-driven accountant.
Yes.
And she has been saving $3,000 per year since she got her first job over 5 years ago.
Yes.
She's keen on getting onto the property ladder, aren't we all?
Yes.
What advice do you give her?
Well, I think the first place to start is that really, when you're coming up to look at a mortgage, the first thing you need is to consider if you can save up a deposit.
Right.
And the more deposit you have, the easier everything becomes.
Right.
And it's one of those things in lending, the more money you have, and the less you need the lending,
Yeah.
the more people are keen to actually lend it to you.
Right.
So what that means is that if she can build up a deposit over time, that will help her a lot. And typically in London, the more deposit she can get, the better. The other thing that would be important is that as an accountant, she has a genuine sort of, she has a good solid, we would expect a good solid job with a good solid salary.
Absolutely.
Sometimes accountancy and solicitors is one of the rare situations that sometimes a lender will allow for the fact that because their salary, an accountant's salary or solicitor's salary, can go up by agreed steps over the years, a lender will actually give them a little bit more in some cases.
Okay, so more generous, I suppose.
Yes.
Okay, so let's go move on to Majni now. Majni, he's 39. Okay, Majni.
Yeah.
He's single man, and he has actually got a mortgage. for a residential property,
Yeah.
it seems. He wants to change that to buy to let.
Yeah.
Are there any complications with such a change?
There could be, because by law the regulators would expect the building society to look into the reason
Yeah.
that he would want to change his mortgage in that way.
Yeah.
If it's the case that, let's say, for example, he's had to move up to the north of England to
Yeah.
do a job, and his house is empty, so he feels he should let it out for
Yeah.
a time, or he's going abroad for a time and wants to let it out. He can go to his lender, as
Yeah.
it stands, and say, can he have what's called consent to let? In other words, will the lender will just give him permission to let?
Otherwise, it was a
Straight.
breach of the terms of the agreement. I
Exactly.
suppose.
Otherwise, there are potentially problems.
Yeah.
Quite serious ones. So he would go to the lender,
Yeah.
and if he's had the mortgage for a good steady time and he's going off for a really good reason, then
Yeah.
they'll most likely say, yes, that's fine. You can go ahead and rent the property out.
Yeah.
Again, where the consistency doesn't happen is that some will say, well, that's fine, keep the mortgage exactly as it is. Others will change the mortgage to charge a little bit extra by putting in place a buy-to-let mortgage.
Because it's varying the agreement, isn't it?
Oh, yes, it
It's
is.
forming a new one.
Yes, it is, and this is the thing that with some lenders they take the view that really actually no, it's not a change in agreement. It's just he's moved away from a bit, and would it be all right to do this? And they take a very traditional, old-fashioned way in it, which is the way it was done years and years ago. Because there's now a very prominent market in renting properties out. Most lenders will take the view that it's a change of the terms of agreement and will try and bring in another mortgage. So perhaps in those circumstances, if he switched to a buy-to-let mortgage, which is another option, he would then be able to show from the rent he might be getting
Yeah.
whether he can afford it, and he would be able to show that the property was in good condition and good to let out, and they would be keen to that.
Okay, so now briefly, what happens when you do default?
Right, if you default, that would mean that you no longer can pay your mortgage or no longer want to pay your mortgage for whatever reason. And when that happens, the lender has to begin a process quite quickly where they will, first of all, look to see if they can help you sort out your problem.
Right.
If you couldn't sort out the problem, eventually they would go to the place where they would actually say, well, no, we must go to court and we'll take the property back from you by what's called a repossession order in court. Most lenders will try not to do that, and they'll do their best not to, for so many good reasons. It stops them getting income from the money, huge costs. They don't really enjoy doing it on a human basis. So lenders will be reluctant to do it, but they will, because of if they take too long, they can be criticised. They will certainly go about a process, typically at the end of perhaps 6 months. The thing I would urge anyone to do in those circumstances, first of all, do your best to see if you can actually keep everything going. If you find that you really can't, then it's time to have a conversation with a lender. Now, if you're not used to that, that can be a little bit frightening. But if you can have a conversation with the lender, they're very ready to talk to you. And for instance, if you've missed a payment, they will often avoid problems with default by saying, well, we can put in a payment plan instead to help you do this.
So another payment plan.
Exactly, yes. A sort of a mini plan within the plan.
Oh, right.
And that helps avoid default.
Okay. Well, looks like you have done a great job, Robert. But before we go, let's just talk about quite a few tweets. We have one tweet from Shami Chakrabarti. She says, "It is unfair that I can't get into the property ladder. It is impossible these days." Shanti from Newham, "My parents have saved up money for me. This is why I can do it." So what's your opinion on those things?
Well, one of the problems within London particularly, and this is where there's a big difference across the regions. If you went, for instance, to South Wales or Bradford, perhaps, in the north of England, it's much easier to buy a property because good properties are cheaper.
Absolutely.
In London, there's a very special thing happens that people are investing in property as a safe way of keeping money. And because there's a lot of investment in property, it makes the prices higher because people compete then to buy the properties.
Absolutely.
That means on an ordinary salary, on a nurse's salary, a postman's salary, or even on a doctor's or accountant's salary, it's now very, very hard to buy a property outright in London. a lot of my colleagues actually say now that live in London, have really nice houses in London, say
Yeah.
they couldn't afford to buy their own houses now. So saving up is one of the ways, I think.
So basically, Robert, before you go, give us your 3 bullet points when it comes to saving money for mortgage. 3 bullet points.
Yes, putting money away in either perhaps an ISA, if that's a good way of doing it.
Yeah.
Being careful to watch for your credit, and being careful that where possible, all your earnings are provable, and you keep the bank statements and things ready to show somebody in that way.
Well, in this case, Robert, thank you very much, our independent financial advisor.
Thank you. Thank you for making me so welcome.